Right, welcome everybody on behalf of Sullivan and Worcester's London office to our September webinar. I'm Geoffrey Wynne, and you're not going to see very much of me today because I'm going to leave you in capable hands in a moment. The subject for today is issues with letters of credit and how to deal with them. And judging by the number of you that are listening in now and who clearly won't see it, that we have picked a topic with quite a lot of things to be discussed. And consequently, I'm going to hand over to Sam Fowler-Holmes, who is one of my London partners, and Hannah Fearn, who is our managing associate, both well known to you. And they're going to take you through the issues and how to deal with them. If you have any questions, you'll see that you have a Q&A button and a chat button, and we'll deal with any questions that you have at the end, or you can email us separately and we can deal with them separately. We are going to have one more webinar at least in November, and we have not yet decided on the topic, so this is your chance to guide us as to what issues you think are most important that you'd like us to deal with, either in the next webinar or just generally going forward on that. And without any more ado, Hannah, I think I'm handing over to you first. Thanks.
Thank you, Jeff, and thank you everyone very much for joining us. This webinar is going to be split essentially into two parts. I'll be speaking for the first half and then I'll be handing over to Sam. In part one, we're going to do a bit of a back to basics of LCs. So just looking at the key features and uses of both documentary LCs and standbys, the roles of the parties and some key terms. We've got some diagrams in there of the process for issuance and a claim for those who are perhaps less familiar with the topic. I'm sure lots of you will be very familiar with it already, but hopefully it's a useful recap. And then in part two, Sam is going to really focus on the main sort of point of the webinar, which is those key issues and how to deal with them. So looking at some of the different uses and structures and some issues around that. Looking at some problematic provisions that we often see in LCs, so things around governing law or an absence of a governing law, sanctions, using governing law, governing rules such as UCP, which is primarily designed for documentary credits for standbys. Sam's also going to look at a little bit at the relationship between the issuing bank and the applicant in terms of the reimbursement arrangement. Some issues around presentations and discrepancies, non-documentary conditions, things like that. And just to finish off with a bit of a look to the future of LCs as we, in an increasingly digital world, and how there are rules out there and provisions that can respond to that. So starting with just some key features and uses of LCs, we're going to look at the two different types of LCs, so documentary and standby. Although they can look very similar and are often in fact subject to the same governing rules, they are conceptually very different in terms of why you would put them in place in a transaction. So a documentary LC is really an instrument of payment. You've got a sale and purchase of goods between a buyer and a seller. You have your parties that want to ensure that if the goods are shipped, that the seller is going to get paid, and the buyer wants to ensure that it's actually going to get those goods. So what we have is an irrevocable promise made by a bank to pay on presentation of the compliant documents. And from the seller's perspective, that substitutes the credit risk of the buyer for that of the bank. And from the buyer's perspective, they can be assured that if they make payment, they will get the documents that allow them to take control of the goods. Fundamental principle of letters of credit and the law that has developed around them is the principle of autonomy, that the LC is independent from the underlying transaction. Any dispute in respect of the underlying transaction shouldn't impinge on the obligations of the parties under the credit itself. There are a matrix of different contractual relationships. It's not just one contract. You have a relationship between the applicant and the issuer and then other banks within the structure, and between the issuer and those banks and the underlying beneficiary. And there are some of the issues that Sam's going to touch on later look at different aspects of that matrix of contractual relationships. And documentary LCs can also be used as a tool for financing. It's not just about payment. It can allow a seller to get paid while a buyer doesn't actually have to make payments until later, in order that it can deal with the goods, on sell them and so on. So it can be a really useful tool to allow sort of bridge that financing role in a transaction. Standbys, on the other hand, are about credit support, and then we're looking at the allocation of risk of non-performance. So it might be a risk of non-payment under an underlying transaction, or it could be another aspect of performance. For example, in a construction contract, that the party that's undertaken to construct something will actually do so, and it's there as a credit support to provide for payment of essentially damages in case that party doesn't perform. So again, we are looking at an irrevocable promise to pay made on presentation of a compliant demand. Again, absolutely fundamental that it's an autonomous, independent instrument. We have the same matrix of contractual relationships, but SBLCs, rather than being instruments of payment, actually share many conceptual features with things like demand guarantees, other types of risk distribution agreements, risk sharing, things like having an insurance policy or having a risk participation. These are instruments that essentially give you a comfort that you are going to get paid if there is a default in an underlying transaction. So looking at some of the roles of the parties in documentary LCs first, we have the two underlying commercial parties. So we have the buyer of goods, they're the one that owes money, and they're the one that applies for the issuance of the LC in order to make payment for those goods. We have the beneficiary, who is the seller of the goods in the underlying contract, and they are requesting payment by LC in order to give them that security of payment. And then we have all the various roles that banks can take under an LC. So the key role is that of the issuing bank. They're the bank of the applicant. They're the one that issues the LC and has the obligation to pay. But we also have all these other roles that different banks may take on. So we have the advising bank. Generally speaking, these are cross-border transactions, and therefore the beneficiary may well want their local bank to essentially advise them and confirm that the LC has been opened. They're essentially acting in a messenger role. Because of that cross-border nature, in terms of being able to make presentation of the documents under the LC, you may want to do that locally, and therefore the LC may be available with a specified nominated bank. It may be available with all banks, and the nominated bank has no obligation to accept a role under an LC, but can do so, and once it does so, it forms part of that matrix of contractual relationships and it'll have rights under the LC. It's also very common to see the beneficiary's bank confirm the LC. Again, the beneficiary is going to be concerned about who it's going to go to for payment, and therefore may well want its own bank, a bank with whom it has a relationship, to be the one who has that undertaking to make payment, and that'll be the confirming bank. In the context of transferable LCs, which can be used in a chain of transactions to essentially transfer the benefit of that LC to a new beneficiary, perhaps further down the chain, there'll be a bank that acts as transferring bank, and they're responsible for advising the LC to the next beneficiary. And then we also have the concept of negotiating bank. So this is a bank that can purchase the documents that have been presented by the beneficiary under an LC at a discount in order for the seller to get paid quickly, and then they will go to the issuing bank in order to get payment for the LC. LCs are typically very short documents. You'll have the key commercial terms, so the parties, the amount of the LC, in how it is available, which will come on to the different types of availability later. What's the expiry date? Where must you make presentation? Are partial shipments allowed? Things like that. Absolutely key is the list of documents that you're required to present in order to give a complying presentation. And that is something that both Sam and I are going to touch on a bit later, because that's one of the areas where there can often be issues and that can lead to discrepant presentations or problems getting reimbursed. We also see some other terms potentially, and that again, this is going to really feed into those key issues. So things like sanctions clauses, it's not uncommon to see those. Governing law and jurisdiction clauses, perhaps we don't see those as often as we'd like, and those are some of the key issues that we're going to come on to later. One of the reasons that LCs can be so short is because they will typically incorporate some form of governing rules, and for documentary LCs, that's invariably UCP 600. The whole point of UCP is to harmonise practice of these international instruments. They're very well recognised rules. People in the industry are very familiar with them, but ultimately they are not law. They are just a set of published rules, and therefore the actual interpretation and how they're applied will depend on the governing law of the credit. And in fact, that they have been incorporated into the credit. You know, it's possible for an LC to be issued without incorporating UCP, and then those rules won't apply. And that can give, you know, in a case of a dispute, that could give the courts a bit of a challenge in terms of actually, well, how do we, to what extent are we going to kind of imply kind of standard provisions in terms of how these instruments are supposed to work into that contract if the parties haven't expressly incorporated the rules that are going to apply. And because it's just a set of rules and not law, they can be amended, and you'll sometimes see rules being disapplied or adjusted to reflect a specific transaction. Perhaps less familiar to some of us is ISBP, which is another set of rules that's intended to be read in conjunction with UCP. And it really sets out sort of the standards for document examination. It highlights how different articles of UCP are intended to be applied and interpreted in practice. It gives meaning to certain words. So, for example, it covers common abbreviations. It talks about how certain dates are calculated. It goes through quite a lot of detail about different types of documents, like transport documents commonly presented under LCs, and it gives some meaning to certain of those provisions and guidance. So it's a really important one for practitioners to be aware of and familiar with when dealing with UCP, because they really are two sets of rules that are supposed to be read together. So we're going to go through the process for issuance and claim under documentary LCs. We've just chosen a very sort of standard structure to illustrate this, but actually there can be quite a bit of variety in these structures, but this is sort of the basic structure. So you have a buyer and a seller that have entered into a commercial contract sale. There is a commitment on behalf of the seller to deliver and a commitment on behalf of the buyer to pay. However, the seller wants its payment to be by way of a documentary credit. So the applicant will apply to its issuing bank for the issuance of an LC. It will give a counter indemnity in favour of the issuing bank and pay a fee for the issuance of the LC. And then the issuing bank will issue the LC. Now, in this case, we've assumed it will be to a confirming bank who will be advising the LC to the beneficiary. So the advising bank, the LC text is sent through to the seller's bank, the advising bank. The advising bank adds its confirmation, which essentially means it is now bound to honour the credit, and advises the beneficiary that the credit's been opened and what the terms of it are. Once the seller has the LC in place, it knows it's there, it ships the goods, and rather than waiting for any payment from the buyer, it just goes straight away to the advising bank. Confirming bank presents the documents that are required under the LC. Assuming that those are all in order, so just move to the next slide. Assuming that they're all in order, the advising bank, confirming bank, will then honour the LC. So in this case, we've assumed it's a payment at site and it's made payment to the seller. The confirming bank then needs to forward those documents to the issuing bank and claim reimbursement. The issuing bank will also check that the presentation is complying, and if everything's in order, will reimburse the confirming bank. There is then the contractual relationship between the applicant and the issuing bank. They've got their counter indemnity in place. The issuing bank's going to go to the applicant and say, I've paid out this claim, you need to pay me. But they're not going to forward the documents at this point, because essentially having those documents gives them a certain amount of control over the underlying goods in the transaction. And therefore, once they've got reimbursement from the applicant, they can send those documents, and then the applicant buyer can use those to take delivery of the goods. I mean, we're assuming here that these are goods that have been shipped, there's a bill of lading, and that the applicant is going to get that in time to then go and present that and get its goods off the ship. So what we have on this slide is essentially what I've just gone through, just sort of written down for anyone looking back on the slides at a later date. So there's some key points just to think about when we're looking at the process for making a claim and issuance of LCs. So when we're checking the presentation, that principle of autonomy is going to be fundamental. The bank is dealing with documents only. It is not interested in the underlying transaction. In order for the presentation to be complying, it has to have been made in the correct place of presentation and also within the expiry date. And it's important to essentially make that claim as soon as possible, so that if there's any discrepancies, that you may have time to represent if needed. Once the LC is expired, that's it. A compliant presentation can no longer be made. There's a certain standard for examination that the bank has to adhere to. That's within the UCP and the ISBP. There's going to be ways that they have to deal with certain types of documents and issues, for example, with inconsistent data and so on. But it's important that when the bank is doing this, they're complying with the timelines. They have 5 banking days under UCP to review the presentation, and if no discrepancies are raised within that time, then it's too late. In terms of if there is discrepancy or non-compliant presentation, notice needs to be given to the presenter. There's a format in UCP of what that notice has to say. It needs to be a single notice. It needs to set out the discrepancies, and you don't sort of get a second bite at this. You have to get it right first time. Or they could go to the applicant for a waiver. That is discretionary. They don't have to do that, but as part of the commercial relationship, that might be something that's done in order to facilitate the payment. And if the presentation is complying, they're bound to honour. That might mean paying at site. It might mean incurring a deferred payment undertaking and paying at maturity. It might mean accepting a draft, which creates a negotiable instrument, which then could be discounted. And it's also important, if you've got that compliant presentation and you're a confirming bank, that you then forward those documents to the issuing bank in order to claim your reimbursement. So just a couple of comments on different types of LC and some of the jargon we see. This is mostly in relation to documentary LCs, but it can apply to SBLCs in some cases as well. So a site LC, that's an LC that's payable as soon as the presentation is complying. Deferred payment LC, the presentation is accepted, and at that point the LC is honoured by incurring that deferred payment obligation, which then will be paid on maturity. So that's essentially extending some credit to the buyer, because it means the buyer's not going to have to reimburse straight away, but the seller knows it will get paid on maturity of that deferred payment undertaking. Acceptance credits, so that is essentially where one of the documents presented is a draft drawn on the issuing bank, and they will honour the LC by essentially accepting that draft and creating that negotiable instrument that will be payable on maturity. Or the LC may be available by negotiation, and that means that a nominated bank is permitted to essentially buy the documents, the drafts and the other documents that are presented. It will essentially advance funds to the seller immediately on a discounted basis, and then it will be able to take those to the issuing bank for reimbursement. We also have, we mentioned earlier, sort of transferable LCs. This is where you have a middleman that's essentially going to be on selling the goods, and therefore the first beneficiary of the LC, being that middleman, will then transfer that onto the ultimate beneficiary, perhaps substituting the invoice that is required for the presentation in order to reflect a difference in payments as the goods flow down the chain. In respect to discounting of LCs, discounting isn't a concept actually used in the UCP, but it's essentially available as a financing tool for any of the different forms of LC other than a site LC. Deferred payment LCs, acceptance LCs, essentially the payment is not going to be made by the issuing bank or the confirming bank until a later date in order to extend that credit to the buyer. But if the seller wants to get paid sooner, it may enter into a financing arrangement of some sort of different structures with the bank in order to get paid sooner on a discounted basis. In transactions, you'll often hear people referring to import LCs or export LCs. These are the same thing, they're just looking at the different perspectives. If you are a seller exporting goods, then you're going to be thinking about your export LC. If you are a buyer importing goods, you're going to think of it as your import LC. Evergreen LCs are more common for standbys. This is essentially something that's going to renew automatically year on year unless notified to the contrary. That can be useful in a sort of credit support arrangement where you perhaps have ongoing underlying financing or relationship that you need the SBLC, that credit support, to stay in place for. We can get revolving, escalating, de-escalating credits. So a revolving credit will essentially top up, from time to time, again, to reflect that there may be different drawings made on the LC for different shipments in an underlying buyer-seller relationship. And escalating and de-escalating LCs, the value is going to change based on reference to some sort of external index, relating to the value of the goods, and so on. Back-to-back LCs is essentially another form of having LCs in a chain, but rather than using a transferable LC. So this is essentially where there will be the documents presented under one LC between a buyer and seller relationship will be the same as under the next relationship, where that buyer then on sells to another buyer. There are some risks with doing that, because you have to really make sure that the terms of those LCs really match up to ensure that the documents are going to flow and ultimately payments going to flow the other way. But it's certainly a useful way of ensuring the payment flows down a supply chain. And red clause and green clause LCs are essentially a way of the seller being able to draw credit under the LC before the goods have been shipped, or in the case of a green clause, once the goods are in the control of the bank. So looking very quickly at just SBLCs before handing over to Sam. So similar roles, we're not going to be looking at things like negotiation with an SBLC, but you have an applicant, an issuer, you may have a confirming bank and a beneficiary. Same sort of key terms, the amount of the LC, when does it expire, where does presentation need to be made, what is the form of demand that needs to be presented in order to make a valid claim. It's useful to set out the form of demand wording. It will, for example, we confirm that there's been a default in this underlying transaction and we claim this amount from you. It can be really helpful to actually specify that in the credit so there's no confusion when it comes to making a demand. Similar to documentary LCs, there may be other terms in there, governing law, sanctions, and so on. In terms of the governing rules, there are ICC rules specific for standbys, which is ISP. They're very useful, quite comprehensive. They really they work for SBLC specifically, but in practice we do often see UCP being used for standbys as well, and Sam's going to touch a little bit more on that later. So here we've got the process for issuing SBLCs. We've essentially chosen the same sort of structure as we looked at for documentary credits. Again, this could be quite different. It might not be to do with goods, the underlying transactions, it could be something quite different. But in this scenario, we're looking at essentially a buyer-seller contractual relationship with a commitment to deliver, but in this case the buyer has to make an advance payment, and therefore by making that advance payment it is taking a risk on the seller's performance, i.e. the seller is going to ship those goods in due course, depending, if it's 90 days in advance payment, that in 90 days they are going to ship those goods. So what the buyer wants in this case is for the seller to provide a standby that it can claim on if that seller defaults. So the seller goes to its bank, it applies for the SBLC, it puts in place the counter indemnity, it pays the fee. This is then issued. In this case, we're assuming there's a confirming bank in place, which is the buyer's bank. So they will add their confirmation and advise the SBLC to the buyer. The buyer now knows that it's got this credit support structure in place and it makes its advance payment under the contract and waits to see what happens. Now, if the seller delivers when it should, then that's it. No claim would ever be made under the SBLC. It was just there in case, it will expire, and the bank will have no further liability under it. However, if the seller fails to deliver, then the beneficiary can make its demand under the SBLC. It says they've failed to deliver, we're claiming this amount. The confirming bank will then check for compliance, and if all in order, make payment. The confirming bank then notifies the issuing bank of the claim and requests reimbursement, which it should receive from the issuing bank, who will then make a claim on the applicant for reimbursement, and then that will be to do with, hopefully they will get paid. It may be that the applicant hasn't shipped because they've gone insolvent, in which case that's going to potentially mean the issuing bank is in a more difficult situation, but in theory that's where the issuing bank would go for their payment. And again, the structure I've just outlined is just on this slide as a summary for anyone looking back in future. So I'm now going to hand over to Sam, who's going to go through some of those key issues in respect of LCs.
Thanks very much, Hannah. Just whilst I share my screen, we have had one question already, which was questioning why in the documentary LC structure you would have the confirming bank. So I don't know whether you just want to touch on that, because obviously that will sort of be relevant to one of the first things I'll touch on.
Yeah, so these are generally, international transactions, and buyers and sellers, they tend to have they have relationships with their banks, and therefore the reason for having that confirming bank in place is, rather than having to go to the issuing bank, you may be in a different location. You know that you can just go straight to your bank, your confirming bank, and make the presentation. They will pay you, and then they will go and deal with the issuing bank and get payment. And so you're looking at sort of facilitating that cross-border relationship, but also it might be that, again, it could be around a comfort in terms of where you're going to get your payment from.
Super.
So to add to that, Sam, but I think hopefully that.
Yes, no, excellent. Thank you very much, Hannah. Welcome, everybody. Thank you very much for joining us today. As Hannah mentioned, and as you can see on the title for part 2 of this talk, I'm going to be looking at some of the key issues around sort of the letter of credit market. What I would say is that whenever you use certain words, there's a connotation or inference that people draw from using that word. So I'd like to be very clear from the outset that key issues is for brevity. Issues does not mean that we see the points I'm going to talk about as necessarily being negatives or things to avoid necessarily, but we've compiled this second part based on recent trends we're seeing both in the market, in the sort of the questions and the comments and the transactions that we're doing with our clients. Some of these are points that rear their head periodically. Some reflect market practice generally in that interaction between the commercial way that these instruments are used and some of the legal points and legal concepts and issues that arise out of the way that the market uses these instruments. So I just wanted to sort of set that out before anybody sort of then follows up and says that they're sort of concerned that we're putting a negative spin on some of these things. That's certainly not meant to be the takeaway, but rather to flag some of the legal issues that go alongside the market practice, and in particular how we can, where issues do arise or problems do arise, how you can help to mitigate those, and that's what we're going to be looking at in the next part of this talk. So I'm going to start with structured letters of credit. For some of those, they've been around for quite a while. Some of you may well know it by the former name, which the market is very much moving away from, which was synthetic letters of credit, sort of very Harry Potter-esque. That's a bit like saying Voldemort nowadays. So we certainly now refer to them as structured letters of credit, which is the terminology the market's using. And Hannah's already, as part of the reason for doing the introduction and laying out the basic overview of documentary letters of credit, is to be able to see the different ways in which these instruments are used. They are primarily a method of payment, as Hannah outlined, but with deferred payment letters of credit, they are also a way of extending credit terms to the buyer. And the structured letters of credit are, I see it as sort of a third variation of the document letter of credit, in that it can be used primarily as a means of raising finance, and raising finance for the issuer of the letter of credit. I'm going to contrast a structured letter of credit with what I call a normal documentary letter of credit, which is the very stereotypical letter of credit that Hannah has just talked us through, because there are a number of similarities between these instruments, but there are a number of key structural differences between a typical structured letter of credit and a relatively typical or normal documentary letter of credit. That's not to say that some of the features of a structured letter of credit you can't have with a normal documentary letter of credit, but some things are standard with a structured letter of credit that might have different ways of dealing with a documentary letter of credit. I've given you some examples there in this slide, but what I am going to do is just move us on to the next slide so that you can see sort of a transactional diagram of a structured letter of credit. And what you can see here is this looks like what I would call the sort of four-corner or four-party model, in that we have an applicant, a beneficiary, an issuing bank, and a confirming bank. And then you can see that we've also added in an end buyer here as well. But whereas with a documented letter of credit, although for cross-border transactions, it's very common to see a confirming bank involved, it's certainly possible to do it without the confirming bank, the so-called sort of three-corner model. With a structured letter of credit, by default, you are expecting to have a confirming bank involved for reasons that I will explore now. So we've got beneficiary and applicant, underlying purchase contract. That purchase contract will provide for payment by the buyer of the goods on deferred terms. We've put it as 360 days. So the buyer, being the applicant, will go to the issuing bank to request that the LC is issued. That letter of credit will be issued on a deferred payment basis to match the underlying purchase contract. We will have a confirming bank, as I say, for reasons that we will explore, who will confirm that in favour of the beneficiary. Now, compare this with a normal documented letter of credit. The beneficiary and the applicant are typically unrelated parties, may well be located in different jurisdictions. For a structured letter of credit, the parties, the beneficiary and the applicant, are very likely to be related parties, companies within the same corporate group. And as I say, that reflects the fact that what we are looking to do here is provide financing to the issuing bank. So for the consideration and the way that that financing is provided is typically either through the provision of cash cover by the applicant to the issuing bank, or a prepayment of the applicant's reimbursement obligation to the issuing bank. But whichever approach you take, the idea is to be able to provide liquidity, to provide the cash upfront to the issuing bank, to enable them to have that cash available to them for the tenor of the letter of credit for the 360 days. There's a couple of very key points to be aware of from this structure. And we really are obviously going to move through this quite quickly, but I would certainly refer anyone who is interested in the product or would like to learn more about it to the IPFA paper that was published, I think it was early this year or last year, which is a very good overview and focus on structured letters of credit and goes into more detail than we have time to cover today. But one of the key things to take away from structured letters of credit is that there needs to be transparency in the structure. This is a structure that can provide a benefit to all of the parties involved here. So for the issuing bank, as a sort of the key party here we're trying to provide financing for, it's the ability to access cash and financing at a lower rate than they would be able to do if they went into the capital markets or the debt markets. Issuing bank would typically be paying some form of interest where it's cash cover, or would offer a sort of a discount rate or an interest rate if there's a prepayment, so that the applicant pays less than the face value of the letter of credit, on the basis that when you get to day 360, the amount that the issuing bank has, if you take into account that interest value, would be equal to the face value of the instrument. So the idea is, for the issuing bank, it's got to be a cheaper way of accessing funds than would otherwise be available to it. For the corporate group, so the beneficiary and the applicant, same members of the corporate group, we need to find a way of obviously having a benefit to them. And typically the way that we do that is contrasting and playing off either the lower amount that the applicant pays by way of a prepayment, or the interest that it earns on having provided cash cover. That needs to be greater than, and this is where the confirming bank comes in, the discounted proceeds that the beneficiary gets from having the LC discounted by, and here we're working on a more simplistic structure, that the confirming bank is also going to be the discounter of the letter of credit. It need not necessarily have to be that way. You could have a third party bank performing that discounting role, but in most cases, the confirming bank is there in reality to be able to discount the letter of credit that it has confirmed. So by doing the discounting, the beneficiary will receive funds earlier than 360 days, obviously at a discount. So let's say it was for $1 million, they may take 990,000 rather than the million. But the idea is that the payment made by the applicant, or the cash, the interest on the cash cover, will be more than the discount that the confirming bank has sort of applied when making the early payment to the beneficiary. And then from the confirming bank's perspective, there will obviously, as I say, it's the discounted amount that they will be making as sort of their profit for being involved in this transaction. Now, structured letters of credit, like all letters of credit, they involve elements of risk. Particularly from the confirming bank's perspective, there's the same issues with receiving documents, making payment against those documents, and then having to forward those documents to the issuing bank, who will then make their own determination as to whether or not there was a compliant presentation. There's still insolvency risk on the issuing bank, albeit mitigated, the intention being mitigated via the fact that the issuing bank has received the prepayment or the cash cover. But I come back to the point that I make about transparency. With this structure, it is vital for anyone who is considering doing this structure or is doing this structure, so that everybody knows what the letter of credit is there for, what it's being used for, that there is primarily a sort of financing goal to this for the issuing bank, because this is where we have seen, and there's limited case law on these, but where it does arise, it is typically because somebody in the transaction, whether it's the confirming bank or the issuing bank, if it's insolvent, for example, and there's an insolvency practitioner, somebody is looking at a way of unwinding this structure. And the best scenario that someone trying to unwind the structure can pick upon is to say, I didn't know that this is what the parties were doing. I thought this was a typical normal documentary letter of credit. Had I known that the purpose of this was to finance the issuing bank, then I would not have done this structure. So that's why transparency, openness is key to all of this. And equally alongside of this, and again, it's why I think the market has moved clearly away from this idea of synthetic and the sort of negative connotations that that word can sometimes introduce in our industry. There needs to be a valid underlying transaction between the beneficiary and the applicant in exactly the same way as we'd be looking at that if this was a normal letter of credit. Because without that, again, you are opening up challenge to, was this really a true transaction that the letter of credit was reflecting, or was this a sham? And if you've got a true and genuine underlying transaction with the same processes of transfer of title, the same documents you would typically expect to see, then again, you are providing a way to demonstrate that this is just an inherent flexibility of letters of credit in the way that it can be used in our industry. And it doesn't open the door up for anyone looking to challenge that this is not true letter of credit business, or this is a sham, or this isn't something we should be doing. So if there's two takeaways from this, which is a very brief sort of scratching the surface of structured letters of credit, it's that transparency and openness, and ensuring that, as we would with normal letters of credit, that we have a genuine underlying trade that forms the basis of this. So moving on then to the sort of second issue is silent confirmations, which is, I'd say this is the type of thing that for us on the legal side, a bit sort of peaks and troughs in terms of the volume of work that we get in. I'd say a few years ago, we were seeing quite a lot of this work in the market, clients coming to us. More recently, perhaps less so. I think that may well be just the cyclical nature of much of what we do in trade. There's a flavour of the day, and then something else comes along and something falls by the wayside. But silent confirmations are, as I say, they have two ways that we typically see them being used. One way is a promise to negotiate documents. So that might be a draft that's been drawn, presented under a letter of credit. So that's a sort of commitment or an undertaking to negotiate. Or there is, it's used in the sort of, in my view, the more common way, which is it's a third party bank saying, I undertake to pay you if the banks that are sort of party to that letter of credit, so the issuing bank, and if there's a confirming bank, the confirming bank, if they fail to do so. So very much sort of akin to a guarantee in that scenario. Both of these are scenarios that fall outside of the scope of UCP, which Hannah was obviously talking about being the typical set of industry rules that are used for documentary letters of credit. So you typically have a separate bilateral arrangement between the silent confirmer, which is typically a bank, and the beneficiary of the letter of credit. Now, the reason we include this here is not to suggest that this is something that can't be done or shouldn't be done, but it's simply to flag that if you're going to have this structure, everybody, the beneficiary, and in particular the silent confirmer, need to understand how this interacts or doesn't interact with the existing letter of credit and the existing rules, because silent confirmations are not recognised under UCP 600. So if you're the silent confirmer, you need to look at how you get the protections that you would expect to have if you were to ever make a payment under the silent confirmation or to negotiate the document. So typically what you'd expect to see is that the beneficiary would be assigning the rights they have to the silent confirmer. But as some of you will know, and we'll touch on this, UCP 600 has a specific provision talking about assignment of proceeds, but makes very clear that that's not the same as an assignment of the claim. So you then immediately raise the question, if you're the silent confirmer, well, what's my performance risk on the beneficiary? Am I comfortable that they will be able to make the presentations? If they do, then and the issuing bank doesn't pay, or the confirming bank doesn't pay, what rights am I able to get? Is it only the right to receive the proceeds, and therefore I need the beneficiary to be continuing to take the action against the issuing bank or the confirming bank for the non-payment? Or is it possible to be able to get the right to be able to bring those proceedings myself, which as the silent confirmer is what I really want to have? So that there's a natural tension there that needs to be considered. If you are the silent confirmer doing it on a negotiation basis, then one of the things you will be looking to do, and we know a number of our clients wouldn't consider that structure unless the credit is available to all, so all institutions can be nominated banks, because in that scenario, if you do negotiate in that scenario, then as a nominated bank, you bring yourself within the scope of UCP once you have honoured by negotiation. And that gives a great deal more comfort than the structure where you do the silent confirmation by way of sort of a fallback guarantee. I will pay if the issuing bank or the confirming bank don't pay. In that scenario, you're not going to be covered by UCP 600. So if you have committed to the beneficiary to negotiate, but the credit is not available with all institutions as nominated banks, then you don't get that protection. And that's going to mean you have to think very carefully about whether you're happy with that risk and how you can deal with it. And then finally, the fraud risk here, we mentioned this because for those of you who are more familiar with UCP 500, be aware of the so-called Santander case, where there was an intervening fraud between the confirming bank having discounted and making the claim on the issuing bank. That fraud risk was identified and addressed in UCP 600, but it's still again a point of, if you're not within the scope of UCP 600, how do you deal with that fraud risk? Third issue is looking at, and the next two issues are governing law and jurisdiction clauses. Hannah has already touched upon this. This is something that, as I alluded to earlier, the issue of market practice versus what we as lawyers like to see in the documents. I think it's still fair to say that market practice is very commonly not to include either a governing law clause or a jurisdiction clause within your letters of credit. I'm not going to read through the slides here. You can do this at your own leisure. We'll make these available. But in the same way as I think all of us would typically, if we're doing, let's say it's a loan agreement or a security document, some form of sale contract, supply contract, very unlikely that anybody is contesting that this should be a governing law clause or a jurisdiction clause, because we are so ingrained that that's what we expect to see in those documents. And hopefully you're all giving due consideration as to why you've chosen a particular governing law or why you've chosen a particular type of dispute resolution. But even if that's not the case, still typically you're expecting to see those. However, for letters of credit, standby letters of credit, other forms of payment instrument, it just is that same thought process just isn't there because of the way the market's developed. Now, there are a number of reasons why that might be. Hannah's already talked about the fact that when we have these different parties involved in letters of credit, it's like a matrix of bilateral relationships and bilateral contracts. all of which, technically speaking, could have their own separate governing law to regulate that relationship. Sometimes it's because of the cross-border nature, and we don't want to get into the negotiation of I'm the beneficiary and I'm based in the UK, I want English law, but actually I'm a French issuing bank and I'll feel much more comfortable if I am, if my governing law is French law. So there's always going to be that natural tension between what the various parties involved in the letter of credit may favour based on typically where they are located, or perhaps the governing law they're most comfortable with or most familiar with. So we understand that there are always natural tensions as to why you may not want to have a governing law in there, because the challenges it brings for negotiation, and because simply of the huge volumes of these instruments that are issued on a daily basis, that extra bit of negotiation just starts impacting on sort of the instruments that are the lifeblood of the industry. So we totally understand that. But what it is important to be aware of is when things do go wrong, and again, the amount of times it goes wrong is a small percentage of the overall volume that are issued, but it's important to be aware that when things do go wrong, the absence of a governing law clause and the absence of a dispute resolution clause, that is the sort of my litigation part, that's the stuff of her dreams, because that is where there is likely to be more dispute in some cases than actually the point that's in contention in the first place. Because what you can find is people forum shopping, choosing the governing law they think is best, applying that retrospectively to the contract, to the letter of credit. And you can easily see, and it does happen, the amount of litigation that is spent on what should the appropriate governing law be, what's the appropriate forum for this dispute, and the fact that you can go to one court and get one answer, but then go to another court and they will tell you a different answer. It raises this huge amount of dispute potential. So whilst the market is not fully moving towards embracing governing laws, albeit we do see this being included in certain instruments, you do at least need to understand and be aware of, when something goes wrong, the impact of not having a governing law or jurisdiction clause, and how that is likely to exacerbate a situation that is clearly already difficult if there is a dispute that is getting to that level of litigation, whether you in arbitration or whether you're in the courts. So I'm not going to go into that any further, but the message is always, if you're not going to include it, and we've given you reasons why it's worth considering it, be aware of the impact of that, and sort of be willing to embrace that risk and weigh it up against the sort of the commercial benefit by not spending that time of negotiating for every single instrument the governing law and jurisdiction provision. Sanctions. Very hard to do a seminar in our industry at the moment, regardless of what the topics are, and not touch upon sanctions. Certainly sanctions are not a new thing in our industry, but it's fair to say that in the last couple of years, these have been at the forefront of all types of financing, all types of structures, and letters of credit are certainly not exempt from that. The ICC has written a couple of papers. Guidance first published back in 2014, but I found seminars that they were giving going back to the start of last decade. They updated that guidance in 2020 in light of a regrowing trend of letters of credit being issued with sanctions provisions in there. And the ICC had tried to bring the attention back to, why do we have letters of credit? What is the underlying purpose of this? And focusing very much on the independent nature and the irrevocable nature of these instruments, and how that is so important to really giving to the use of letters of credit. And what we were seeing going back to the middle of the last decade, which is what brought about the ICC's guidance paper, was that with sanctions again looming large at that time, is that issuing banks were starting to put sanctions clauses into letters of credit. Sometimes they were simply reflecting the position at law and saying, we have to adhere to the laws that are mandatorily applicable to us, and where that is the case, we cannot perform if to do so would put us in breach of sanctions. The ICC said, look, we understand that you don't, most jurisdictions, you don't need that because the law says you can't breach sanctions, so you don't need it. But we don't totally object to that because you're just reflecting what the position at law is, and there's an element of just making it clear to everybody you need to be aware of this. But as ever with these things, you start seeing a sort of a sanctions creep, in that particularly the banks start saying, well, actually, we've got policies and procedures, and we also have to apply to those as an institution. And if we are unable to pay, because to do so would be contrary to our policies and procedures, well, be aware, beneficiary, or be aware, confirming bank, we won't perform if to do so would put us in conflict with our policies and procedures. Well, that immediately raises the question of, well, what are your policies and procedures? And I'd be very interested to see if anybody's brave enough on listening in to say whether they would ever be willing to share their policies and procedures with the beneficiary or with fellow banks who might be the confirming bank, for example. I suspect the answer to that is probably not, or only at a very high level. But in many cases, the concern of the ICC was we're starting to erode that independent and irrevocable nature and introduce uncertainty into the instruments which are designed to take away that uncertainty. So the message, I think, on the sanctions front is, if you are going to include a clause, or you're going to accept or be party to a letter of credit where another party has the benefit of a sanctions clause, do you understand what the scope of that is? Do you know what sanctions they are saying they adhere to, rather than just to all applicable laws or laws we think we should be complying with? And this is particularly true of non-US institutions who do dollar business, which is the vast majority of banks in this industry. We've discussed at length in previous webinars and in papers we've published about the impact of secondary sanctions, particularly in the US market, and how that impacts on all of us, even if we're not US based or not caught within the scope of the primary sanctions. You then again, it's that we lose that certainty of, how do I know you are going to pay me if I do everything I should have done in accordance with the terms of the credit? So there's definitely a balancing act between the pressures that all of us face in complying with sanctions across a global industry, but against not undermining the very purpose of letters of credit, because there is a danger that that tipping point is reached and suddenly we are no longer offering a financing method that really does what it needs to do. And once that happens, we're in a very difficult position unless we are willing to consider seriously about that balancing act that we're trying to do at the moment. So there's just a little bit more here about what I've been talking about, what the ICC guidance says, what they're focused on, and really where their concerns are. And as I say, the reason it came out in 2020 was because, again, sanctions hardly ever can you say that it's not at the forefront, but it was clearly back at the forefront again over the last couple of years. And again, you start seeing this creep of these sanctions clauses being introduced. I'm conscious of time here, but SBLCs, Hannah already mentioned about UCP 600 and ISP 98. Very interestingly, even though ISP 98 was designed specifically for use with standby letters of credit, it's still very commonplace to see SBLCs being issued subject to UCP 600. And that's very often because there was a huge take-up of UCP 600, very well used in the market. People like it, they know what it means. And therefore, people say, I'm comfortable with UCP 600, I'm going to use it for standby letters of credit. Generally, there's not an issue with that per se, but it's really important, and this did come out of the pandemic, is people started looking at the rules that they were incorporating into their instruments and saying, actually, I'm not sure whether that is how I expected that provision to be interpreted, or I'm not sure whether that actually is applicable for this particular instrument. And that's definitely the case with using UCP 600 for SBLCs, because Hannah's touched on and outlined why documentary letters of credit are different to standby letters of credit. So therefore, using a set of rules that are designed for, payment instruments where the payment is intended to be made if everything goes well, doesn't always sit easily with an instrument that should only be used and payment will only be made if something has gone wrong. Now, so that natural difference between the two of them does have an impact on how you need to consider whether UCP 600 is always the best to be used with standby letter of credit, or if there are things that you need to consider disapplying or supplementing in your standby letter of credit to make it truly work for your instrument. And I'll just give one very quick example. UCP 600 and ISP 98 both provide for payments in installments. However, UCP 600 says if you don't make an installment, a claim for a particular installment, then actually you can't make any further claims and the letter of credit will fall away if you don't make that first payment. Whereas for a default, for an SBLC, actually, if everything performs well, there may not be a claim on that first installment because the performance was there. You would only have made the claim if there wasn't performance. So actually, you don't want the SBLC to fall away and no claims be able to be made in that scenario, because actually you want the SBLC to continue to remain in place for the subsequent deliveries. So it's really important to make sure that you're looking at the rules that you're incorporating and saying, are these the rules that I need to have in full, or are there things I need to disapply? Are there things I need to supplement? Are these relevant? And if they're not relevant, is it better to disapply rather than ever get into a position where we're trying to argue with somebody to say, oh, but we all knew that wasn't, that's not relevant for this. So, just disregard that, just ignore that. That's what you need to be thinking about with any type of rules that you're incorporating. But particularly, I think with SBLCs, that natural tension between UCP 600, ISP 98, and the difference between an SBLC and a documentary letter of credit. Excuse me, reimbursement agreements. Just one point I wanted to say here is that UCP, ISP, they don't deal with the relationship between the issuing bank and the applicant. That will be documented outside of the letter of credit. We are starting to see, very interestingly, tensions here between the drafting that many of us might be used to, which typically derives in some way from the LMA's letter of credit wording. And we're seeing a lot of applicants starting to really focus on the reimbursement obligation and what the trigger for that reimbursement is, and starting to put more and more language into what it means. What's the trigger? So many of you will become familiar with and comfortable with that language that says, if we as issuing bank receive a claim that is or appears on its face to be compliant, we will pay and you will reimburse us for that. We are seeing a growing tendency of applicants saying, okay, we'll start with that, but we are going to start really being much more specific about what we think your obligation is, issuing bank, to make a payment, the standards we expect you to be performing to before you can come to us and seek reimbursement. So we're starting to see more being put in around fraud. We're starting to see more around the standards of that document review. We're starting to see more around things around materiality, reasonableness, and that's a really interesting trend that seems to be happening, and it's difficult to put your finger on what's caused that, but it is definitely something we're seeing our clients having to deal with. And very often there's that tension between what people are comfortable internally with how they would do their processes, but then committing that to an obligation or appearing to limit the ability to claim reimbursement is a definite tension that we're starting to see in whether it's in your LC issuance facility agreement with a reimbursement clause in there, whether it's the counter indemnity you might have, whether that's in a separate document or baked into your application forms. But that a really interesting trend that we're starting to see, and one that clients are having to be very careful to make sure that they are comfortable that they are still in a position that if they do everything that they think that they should be doing, that they still have that reimbursement obligation. Dealing with issues around presentations, I am very conscious of time, and the slides are very detailed deliberately for this purpose. But we've given some examples of the issues we see when clients come to us with issues where they've received a presentation and that raises some issues. Very interestingly, you can see that figures in the market say that up to almost 80% of presentations are rejected first time for a range of issues. And that obviously brings into focus, does the beneficiary know what they've got to present? Are they able to present those in the way that the letter of credit requires? And I say that particularly around SBLCs, where we see a number of SBLCs that don't have a template form of demand to be presented. And then we see presentations being rejected because somebody says, oh, that's not the form of demand I expected when we had this provision in the SPLC that says you must make a demand and it must say A, B, and C. We expected you to say that in this way, so I'm really sorry that doesn't match up with what you've presented. So for certainty, particularly in SPLCs, we'd always expect to see a demand, template form of demand being used where possible, because that takes away some of the uncertainty for all of the parties involved. That touches in non-documentary conditions. I've already touched on sanctions, which the ICC says that is a non-documentary condition. But it's important, again, particularly with documentary letters of credit, where it's all about the documents to be presented, again, avoiding having conditions that aren't documentary. UCP 600 provides some assistance here and says that you can disregard non-documentary conditions. But again, it's important to be clear, do we know what needs to be presented? Do we know the form of the presentation? Those are the types of issues which result in rejections of presentations. And remember, it's the rejection of presentation that in many cases is what's going to give rise to the dispute if it's not possible for whatever reason to subsequently make a compliant presentation. And it's then going to be on the parties to be able to point out that it was compliant, or to defend the position to say that it wasn't compliant. So that's very important to make sure that everybody knows what needs to be presented. I have a section at the end here on force majeure at the end of this slide, and indeed the next slide. I must confess that after talking about this and the market talking about force majeure during the pandemic at great length, it's hard to become too much more enthusiastic in the time we have available, save only to say that this comes back to what I was saying around understanding the articles that we have in these rules that we're incorporating, and thinking about that interaction between what Hannah said, which is these are contractual rules and market rules that we use, but they still have to be construed in line with the governing law, the applicable law of the instrument. Now, you immediately have the challenge, if there's no governing law stated, what is the law? And English law doesn't recognize force majeure as a concept per se in the same way that civil law jurisdictions do. So immediately you've got a difference in how that concept was being interpreted by different jurisdictions that we work in, but also the force majeure and how it was interpreted in terms of the force majeure provisions in each of the rules, ISP 98, UCP 600. I think a number of people were surprised about the difference between those different rules, and also how to interpret those when we suddenly found ourselves in a position where it was a very live issue, rather than just that's article such and such and nobody really looks at it because it, you know, nobody had to look at it in previous years. But again, the slide has some more information, and I'd simply refer you back to some of our previous webinars we did during the pandemic where we discussed this in great detail. I'm just going to round off then with a final bit which ties in with another key topic that the market's grappling with, which is digitalization. And simply to say that during the pandemic, it was notable that we had a number of people raising questions about how do we deal with paper-based trade, paper-based presentations when the counters of the various banks, they're not open, or we can't, no couriers will send it to this area or that area, a point that we're still dealing with in many jurisdictions at the moment. And the ICC, not unfairly, sort of put its hand up and said, well, look, guys, since 2002, you've had EUCP available. And in fact, believe it or not, we've actually just revamped EUCP as version 2 to make it work for digital transactions, digital presentations for letters of credit. Now, I'd be very interested to hear from people whether there has been an uptake in this or not. We're certainly not seeing much on our side with EUCP being used. But whilst I'm happy to sort of put it forward as something for people to be aware of, the true challenge, and this is something with the digital world, is how do banks are familiar with and comfortable with addressing fraud within the paper-based industry, because it's what we're used to. It's how we've done business for many, many years. It's about how do we address that same fraud risk where suddenly we're not getting paper documents anymore, we're getting things presented via electronic means, electronic data. How do we authenticate? How do we verify? that challenge is not limited to letters of credit by any means, but that is where the future of the industry is going. How do we deal with that key risk? So I think the takeaway here is we talk about the challenges we face. Just don't forget, we do have tools available to us already in the shape of EUCP 600. And indeed, there are digital solutions forever being announced in the world that we live in at the moment that will be, I think, taking forward instruments like letters of credit, promissory notes and the like, which will be all about bringing us into this digital world. So that has been a canter through a number of the issues. If anyone has specific questions they'd like to raise now, and I can see we've got a couple already, or offline, that's absolutely fine. Jeff's already thrown the sort of the floor open to you in terms of additional topics that you might want to hear us talk about. Whether it's any of these that you'd like us to explore in more detail, we're very open to. But for now, that's it from me. I'm going to hand over to Jeff very briefly. I will take a quick look with Hannah at the questions to see whether there are any we can deal with now, or otherwise we can sort of address those afterwards if people have specific issues.
Sam, thanks. Hannah, thank you as well. Yeah, you've got some questions. One that relates to silent confirmations, Sam, which I think you can probably deal with very quickly, or at least I might try. That the liabilities on a silent confirmation, essentially, if you give a silent confirmation, you're agreeing to make a payment to the beneficiary, but you're expecting to be reimbursed by the issuing bank. So just in the normal way as if you were a confirming bank. You've got a couple of questions on sanctions wording, anything creeping into letters of credit, which you might want to take those sort of slightly offline. I mean, I have to say my experience, so because of how wide the sanctions wording, how wide the sanctions are and the concerns, I think we are seeing more banks asking, certainly the major money centre banks, seeking to put more wording into their letters of credit. And then you've got a question, Sam, which you might want to deal with, which is reimbursement obligations under the LMA. And thanks everybody, you're firing more and more questions, which unless Sam or Hannah, you've got time to answer in very, very quickly, I think we better take them offline. Sam, Hannah, do you want to say anything more?
I'll touch very briefly. We will. What I would say for anyone who has sent a question, please do, if you want to send us a separate email, because some of these questions you raise are ones that we could do whole sessions on. So we can sort of provide a bit more detail offline. But for those who obviously can't see the questions necessarily, the LC reimbursement wording. Look, on that, it's forever the bargaining power, isn't it? As you'd imagine, those who are pushing for the changes are, shall we say, the counterparties that have the biggest sway in the market, and therefore there is the willingness to provide more flexibility. The concern that we have when we see this is that's fine, and ultimately it's a commercial point for our clients what they're willing to accept, but you need to be comfortable internally that whatever you are agreeing to, what you are saying you will agree to do as part of your process for reviewing a presentation and then making payment, that you can't erode that, because if you find that your reimbursement obligation is narrower than the scope of how you would actually review a presentation and make payment against it, you're going to be the one that loses out in that scenario. So I'm certainly not seeing anything that suggests that the LMA, for example, is going to revisit their wording, but it's very much at the commercial level, that tension between, quite frankly, how important is the customer and how much sway do they have and how much willingness is there internally to try and show flexibility there. And sometimes it's just a drafting thing, but sometimes we are seeing people limit what would otherwise have been a broader reimbursement obligation, limiting that in a way that I think is narrowing it beyond what I would typically expect to see. I'll just then touch the sanctions questions are again very good ones about it's that tension, somebody almost saying isn't it easier for the ICC to say you should only be saying you will comply with law, and that's it. but actually the ICC aren't the ones that are having to grapple with the practical realities of being an institution that's received a presentation that has regulators in various jurisdictions monitoring it very closely. And if anybody sets a foot wrong, then the consequences of having been perceived to be in breach of sanctions even can actually far outweigh the risk of having the ability to say, I'm not paying in this particular scenario. So fully understand that tension, but you can also see from the ICC's perspective that these instruments are set out to be vital to the industry. Key independent certainty is the hallmark of them. And what we were seeing is just this creep of these clauses where, quite honestly, I'm not sure that sometimes the bank putting the clause in truly knew what it was they were trying to protect themselves, but they knew that if the wording was broad enough that they could fall back on it if they needed it in any scenario, then that surely was a good thing for them. And that's the problem, is that if you don't know the scenarios in which this is going to arise, where you might suddenly find you no longer have the ability to make a claim when there is no sanctioned activity involved, that makes it very difficult to be able to rely on these instruments for the scenarios we need to.
I can catch you up. Hannah, have you got anything more that you want to add? Because we're sort of rather...
No, I think given the time, it's probably good to wrap up. But as you've already mentioned, if people want to approach us directly with any questions, more than happy to do so. And someone asked about the slides and recording being available. And yes, that will be made available on our website in due course.
So thanks everybody for listening. Again, thank you, Hannah and Sam. I see that there's a suggested idea which we'll have a look at. I think sanctions, we'll talk more about sanctions in the near future. So everybody, thank you very much. Have a good rest of day, rest of week, and we will catch up with you certainly in November and probably before then as well. Thank you all very much. Bye for now.
Thanks everyone. Take care.